So hi, so the last time we looked at this, we looked at potential put and call option values on a couple graphs here. Okay, and you can see after when you start getting in the money, you start making a profit, right? All right, and the same thing with the put. Now, if you're a writer of a call on a put, you collect premiums. Now you're totally obligated to perform if you get called by the buyer of the call on the put. So you're hoping that the option doesn't move at all, so you can collect your premiums and your options don't get exercised, or you are on the hook. So as it's being said here, an option trade is a contract. If you buy a call option, you have entered into a contract with some other trader who, and this is the magic word here, who wrote that call. So the buyer has all the rights and the writer has all the obligations. That may be a small trader like you. So long as you have permission from your brokerage to trade options, you can write them, sometimes with substantial restrictions, just as easily as buy them. So you can not only can you buy them, but you can write them. When you write a call for one contract representing 100 shares, then you create basically open interest of one contract. Okay, so as soon as you write a call, when you offset this by buying to close, if you do that, the open interest falls by one contract. All right, so you write and then you have to buy to close it out, right? To fulfill your obligation. When writing calls, if you own the stock that must be delivered, if the option is in the money at expiration, and this is real important, you are writing a covered call as long as you have it. It says here if you own the stock, so then you're covered. So that's generally allowed without restriction. All right, so let's look at some, again, here's some of the jargon. A call is in the money, otherwise known as ITM, if the strike price is less than the stock price. It's out of the money if the strike price is greater than the stock price. Okay, so you're in the money or out of the money, and if it's if the strike price and the stock price are equal, which doesn't say here, you are at the money. All right, and it's just the opposite for a put. You notice here, in the money for a put, strike is greater than the stock price. So it's in, and the strike is less than the stock. Okay. So the an in the money call premium, okay, is equal to. So the jargon here is a little confusing. It says here in the money call premium, and it's not really done this way. Okay. What they're referring to is the premium is what you pay on the option, which was this right here, the option premium. What he's referring to is the time value. He's subtracting off the what's known as the intrinsic value here. Okay, this is intrinsic, which is the stock price minus the strike price, and that gives you the option time value. Okay, this is the actual option premium. So I don't quite know why he's referring to that, but this is basically the time value. Okay, and the same thing for the put. This is the time value. You see, you got a positive intrinsic value here for both. All right, so suppose I want to buy the November 190 call marked below, which is right here in the diagram. To buy this option, if I submit a market order, it will be bought at ask 315, right? So I pay more, right? I bought it, right? But look at the spread between bid and ask. I really should submit a limit order, though, at ask or below, although it is not at ask, it may not get executed. One option is to submit a limit order between bid and ask, like 310. I wouldn't do that because you're cutting dimes there. Another option is to target an even lower price, put in a day order and hope that the stock and the option dip down. The problem is if you really want it and then it doesn't get executed, you're doomed. So basically the last price was here, and you'll notice the bid and the ask he's what he's referring to walked away. It's gone up, right? Because in this case the market is a little volatile. So here's the way TD Ameritrade's option trading interface is, right? And you basically buy it open. This guy's buying 10 contracts, right? Of the November 19th, 2011 call. And he's got a limit order in at 210, right? And it's in force for the day. And basically fill or kill means fill within seconds or kill. So it's a day trading order, okay? All right, so there's the options, action drop down options here. Order type, okay? You can buy to open, sell to close, or sell to open and buy to close, okay? Or you can exercise it. This is if you're writing the call. You see that? And you could exercise. Use call to buy IBM. So you want to buy the underlying stock. All right, so I'll stop there and then we'll pick up over here and we'll look at how the buy to open call is on this interface here. All right, everybody. Talk to you later.